Hi folks, Colin Richards here, and once again I'm thrilled to be with you on this segment of the Lord and Richards Show. At Lord and Richards, we take you through a process called a Retirement Freedom Review. And in that review, we take your current portfolio and we run it back through past wars, conflicts, and especially the down markets that most people are worried about. And so we are already predicting these are going to continue to happen. And so why would we change the plan when we fully expect things to happen as they keep happening? All right. Let me give you some real statistics that are going to help you a little bit. So you might be wondering, well, can I look to the past then and know what effect war has on people's portfolios? Sure, we can. Take the Korean War. How long did it take for people to recover? Or the Operation Desert Storm, or let's talk about the Vietnam War, all these types of wars. Well, on average, it takes 28 days from the initial shock. So there's usually an initial drop, very typical in the short term, right? Because people are nervous and jittery and everybody wants to get out of the market. And then they realize, oh, war is actually good for the economy. We're actually selling more stuff. We hate that it's weapons, right? But we're selling more stuff, manufacturing more stuff. So it's good for the economy. It really trickles down into a lot of different areas. So 28 days is typically what it takes from the time we see the first drop until a full recovery. You say, really? 4 weeks? Yep. The longest is about 4 months, right? 5 months to recover fully. And so the shortest I saw was about 3 days to recover fully. Americans are incredibly resilient when it comes to war, apparently. It's not that it's a good thing, but I guess we've gotten used to it in some ways. And so don't you be on the fear trade, right? Don't be handing your money to somebody else. Warren Buffett, whom I love to quote, whom I've studied extensively his entire life, all the way back to his childhood, he has a comment that he's made several times. He said, the stock market is a place where, wise investors receive money from foolish investors and various variations on that, right? And so what we don't want to be is panic mode, fear mode, responding to these kinds of things. Here's what actually tends to happen over the year that follows war. On average, markets are up about 14.2%. You say up? Yep. If they're recovering within, on average, a month, then they're generally up after a war. So please don't let war and rumors of wars and the things that we as Christians expect to be going on in the world shake your strategy, right? That's the whole point. Mike Tyson, the fighter, used to say, everybody has a plan until they're punched in the face, right? Well, our plan simulates getting punched in the face. So let's not react. Let's not get reactionary, but let's stick with our plan. Understand that we're going to see down markets on a regular basis throughout your retirement years, 3 every 10 years, 9 or 10 over your retirement. Prepare in advance for that. And we're going to talk about that in our next segment. And so one last comment, people have asked me about oil, right? If you're interested in some great books, actually, I highly recommend Joel Rosenberg's political thrillers if you like great fiction, but he actually tends to be eerily predictive, right? And he's got a book out called The Strait of Hormuz. Well, we've seen that in the news, right? And Iran and its threats and so forth. And so people are worried about oil and it's volatile and all this kinds of things. Well, the S&P 500, when oil is up, averages an annual return of about 13.1%. That's 500 growth stocks in the U.S. When oil is down, it averages an annual return of about 11.3%. Are you hearing much difference there? 2-point difference. So let's not panic. Oil, wars, rumors of wars. Let's stick with the plan. And the most important thing is to get a plan in place right now. It's called a Retirement Freedom Review. And we do it at no cost to you. It's an hour that will be well worth your time to know for certain that you are prepared for the retirement years. Whether you're in it or near it, we want you to sleep easy, rest easy at night, knowing that you're on track for a fantastic retirement. It simply starts with a phone call. Hey folks, this is Colin Richards, president and founder of Lord & Richards. And in this segment of the Lord & Richards show, we're continuing a discussion of the impact of geopolitical instability, things like wars, rapid volatile changes in oil prices as a result of wars, and what that should do for you. And we began with the principle, let's be bullish on the United States. Long term, the United States is the largest market in the world by a factor of 10 in terms of our stock and bond markets. It's growing at a faster pace and good, solid GDP growth relative to all the other developed nations in the world. It is the place to be as an investor. And don't let wars threaten or derail your plan, okay? Because frankly, wars typically result in positive returns over the year following that war, or following the start of it, the onset of that. Because eventually we figure out we're producing more things, right? Oil prices. The S&P tends to be up in both down and up oil markets. So what is our best move here? You say, well, Colin, you're talking about this retirement freedom review. How is what you do different than everyone else? Well, we're specialists in getting you the income that you need. Okay, that's the first thing. So much different than saving for retirement is distributing during retirement. It's calculus, folks, versus addition and subtraction. It's not arithmetic. It is advanced math. Healthcare. It's the biggest threat to your financial future, and most people don't even realize it, and it has to do with the potential for chronic illness. We can teach you how to pay for that with other people's money. It's our specialty. And another specialty has to do with what to do during volatile markets, because what we're going to do is we're going to take principles from the world of institutional investing. Okay, this is a big world, and it's different from retiree worlds, right? In our world of institutional investing, we're talking about colleges, hospitals, endowments, foundations. They have a long-term time horizon that could be centuries. Think about Harvard with the largest educational endowment in the world. How long are they planning? Centuries. They've been around centuries. Do they have a harder job? You bet they do. But there are things that we can learn from these institutions. I share different principles every single week, so I'd encourage you to go back and check us out on YouTube or on Spotify or one of the podcast channels and get these principles. But here's something I'm going to dig into a little bit today and just leave you a nugget about institutional investing. Alternative investments tend to be the largest asset class that institutions are involved in out of all of them. Stocks, bonds, treasuries, foreign, domestic, whatever it is, alternatives. And some of those alternatives can be high risk, no doubt. But many of those alternatives are designed to improve safety. One of the things that we do at Lord & Richards is if you'll visualize a barbell, a term that I really borrowed from Morgan Housel's book, The Psychology of Money. And by the way, if you come in and visit with me, I'll give you a copy of that book. I think it's so important to understand how to invest from the standpoint of behaviors that yield to success versus failure. And one of these is the barbell. And we can teach you how on one side to get completely safe and grow on the same dollar at the same time. Okay, I'm not going to talk about that right now, but just know that that's one side of your barbell. On the other is predominantly equities, stock exposure. You say, well, what about bonds? Here's my feeling. Bonds have averaged around 4%, not the best in the world over the last 10 years. And yet during that time, we experienced a 25% drop in 2022. As a friend of mine likes to say, is the juice worth the squeeze here? 4% in exchange for a potential for a 25% drop? I don't think so. So I'm not real bullish on debt, allowing companies to borrow by way of bonds. What I am bullish on is getting yourself a piece of ownership. Instead of being a lender to a company, why don't you be an owner in that company? Like we've been talking about, get a piece of stock. And instead of just taking the pure risk, okay, on this side of the barbell, we're going to have you exposed to the stock market. Let's put some things in that are going to reduce or mitigate our risk. And hedging is a fantastic strategy. It's used by both individual and institutional investors. Institutions tend to do it at a much larger scale, and that's what we do for you as our client. So as our client, not only will we have on one side of your barbell strategies designed to completely protect you. That's the side you want to live off, right? If you're going to take income, take it off your protected side. But even on the side with risk, your growth, stock, equity portfolio, we're going to add other layers of protection that will help you stay in the market, be worried about geopolitical instability, not worried about wars, not worried about fluctuations in the price of oil. All these things are going to come and go repeatedly throughout your retirement. Expect it to be over and over again. But what we're going to do is hedge. That means we're going to buy a special option strategy. We're going to purchase on your behalf and place within your portfolio option strategies designed to reduce your exposure to the downside. Sometimes we can take away as much as half of the downside risk while still retaining up to 65% of the upside. Do you know what that would mean for your life? To only have half the risk of the market? That's huge, folks. And we want you to benefit and participate in that. And we've been doing this for our clients for so long. It's no wonder we're A+ rated with the Better Business Bureau 5-star reviews. Our clients just don't go. They even say it. We're never going to leave. Well, folks, it all starts with a simple process we call a retirement freedom review. It's completely free to you, and it just starts by picking up the phone and giving us a call.